passes the swing high. In ICT terms, this level represents buy-side liquidity. Just below a swing low, there are a lot of stop-loss orders from long trades, which are sell-stop orders, and there are also a lot of sell-stop orders from traders who want to go short if price surpasses the swing low. In ICT terms, this level represents sell-side liquidity. The identification of buy-side and sell-side liquidity levels is important in many ways in the ICT method. Let's move on to a real price chart and observe examples of buy-side and sell-side liquidity levels. In this 5-minute chart of the mini S&P, we currently have a low. This is a potential swing low because the candle to the left has a higher low. If the next candle produces a higher low, the current candle will be classified as a swing low, which represents a point of sell-side liquidity. Moving forward one candle, we can see a higher low, so we can go ahead and classify this low as a swing low. While we were paying attention to the swing low, notice that we also have the potential for a swing high in this candle. That's because the candle to the left has a lower high. If the next candle also produces a lower high, this point will be classified as a swing high or buy-side liquidity. Moving one candle to the future, we can see that this is exactly what happens, so we can go ahead and mark this as a swing high. Right now we also have the potential to another swing low. If the next candle produces a higher low, we'll have another swing low at this point. Going forward one candle, we can see that it doesn't happen. The new candle forms a lower low. Now this new candle is a potential candidate for a swing low because it has a higher low to its left. In the next candle, we can see that a new swing low forms, so we can go ahead and mark it out. In the next two candles, we can see that price takes out the last swing high and comes back to test it on the other side as support. Over the next four candles, we can see that only higher highs and higher lows are formed. Eventually, price produces a candle with a lower high and renders the previous high as a swing high or buy-side liquidity, so we can go ahead and mark it out. In the next candle, price continues to the downside. Identifying swing points is very simple, but it's a good idea to practice it in replay mode or real time so it becomes second nature to you. Once we start to mark swing points in real price charts, it becomes clear that certain swing points cluster together while others remain isolated, giving rise to two distinct definitions of highs and lows called equal highs and lows and old highs and lows. In this chart, we can see an example of equal highs. Notice how three swing highs cluster together roughly in the same level. Still in the same chart, we can spot an example of equal lows. In this case, three swing lows cluster to form equal lows. Notice that equal highs and lows don't necessarily happen in the same price level perfectly. They simply cluster together in the same area, roughly speaking. Still on the same chart, we can see the concept of old highs and old lows, which are swing highs and lows that stand out or that are isolated in a way. Notice that in the example of the old low, price pierces the old low without closing below it, and then it starts to go up. That's an important idea not only in the ICT's method, but in the overall idea of market manipulation, meaning the triggering of liquidity in order to deceptively induce retail traders to one side of the market. Still on the topic of highs and lows, we can look at other important types of highs and lows in any price chart, namely the previous week high or low, previous day high or low, sessions high or low, or even intraday time frame highs and lows. We'll take another look at that when we talk about the concept of daily bias. Another important concept in the ICT method is the idea of discount and premium zones. To understand that, we must first understand the idea of range, which is simply the space between a swing low to a swing high, or the space between a swing high to a swing low. Let's take the example of the range from a swing low to a swing high for the sake of illustration first. To define the premium and discount zones, we divide the range in two equal parts. The upper zone is always called premium, and the lower zone is always called discount. That's also the case when the range comes from a swing high to a swing low, which would be a downward price movement. Whenever we look for long trade opportunities, we want to enter trades in the discount zone, assuming there are other elements to support the trade idea. The lower into discount, the greater the risk-reward ratio if we place a stop below the swing low and a target at the swing high. For downward price movements, we measure a range from a swing high to a swing low. We want to get into short trades in the premium zone. The higher into the premium zone, the better, because we are able to extract a greater risk-reward ratio, assuming the stop loss is at the swing high and the target is at the swing low. This notion of discount and premium is very simple, but it's something you need to keep in mind when we look at other concepts like optimal trade entries, fair value gaps, order blocks, and the combination of elements that will generate trade setups. Directly related to the idea of premium and discount zones, we have the concept of OTE, which is short for optimal trade entry. The OTE is a specific Fibonacci retracement zone that will fall in the discount zone for a long trade entry